After a quiet second week of May for the US dollar, things should pick up as we await the speech of the Fed Chair Powell. We'll discuss this and more with Bob Mason from FX Empire. This is the Midweek Market Drivers. Hey Bob, thank you very much for joining us. Always a pleasure to speak to you. Let's jump straight in. It's been a relatively quiet second week of May for the US dollar, but we have the Fed Chair Powell's speech coming up very shortly. What can we expect to see there?
Yeah, in terms of Powell's speech on Wednesday, markets are expecting Powell to dismiss the chances of negative rates, actually. We saw the Fed funds futures pricing negative rates late last week, and Trump talked about it this week. Obviously, the US government would be particularly keen on seeing negative rates, considering the amount of debt that it's raising at the moment. Obviously, the government would then get paid for the bond issuances rather than them paying investors. Really, though, Powell's likely to dismiss that. The reality is that there's a long way to go in the COVID-19 economic meltdown, and the Fed's not going to deliver negative rates anytime soon, Trump pushing or not. So some doom and gloom, probably some dovish chatter. Obviously, there's a lot of uncertainties that remain, and Powell will need to manage that in his speech. He's meant to be talking about, the current economic outlook, but he will certainly touch on negative rates because that's been, one of the hot topics over the last few days.
Elsewhere, Bob, let's discuss the Commonwealth currencies. What about the New Zealand dollar?
Yeah, for the Kiwi dollar, we saw the RBNZ sink the Kiwi on Wednesday, holding rates unchanged while expanding its asset purchasing program quite significantly, actually, from 33 billion to 60 billion Kiwi dollars. There was also some pretty dovish chatter and negative sentiment towards the economic outlook, in spite of the New Zealand government curbing and containing the virus over the last number of weeks. Heavy reliance on other economies' key trading partners is the issue, which will likely make the Kiwi dollar particularly sensitive to economic indicators from elsewhere. So that brings industrial production and fixed asset investment numbers from China this week, and then obviously we got a number of key stats in the week ahead, which we're starting to look towards main numbers now, which are going to be particularly telling in terms of how lockdown measures, the easing of lockdown measures, the initial impact on the economy, and the meltdown. So Kiwi dollar sensitivity to persist for now.
And Bob, what about commodities like oil?
Well, crude oil prices have certainly stabilized this week. We saw them actually stabilize last week as well. WTI's up going through into Wednesday. There's some negativity, however. Obviously, there's talk of a second wave of the pandemic, which would certainly sink crude oil prices should governments have to reverse the easing lockdown measures. So that's a material risk for crude oil prices near term. On Wednesday, we've also got the OPEC monthly report and the EIA weekly inventory numbers. OPEC's numbers, we've seen a cut in production, but it's really not about just the actual amount of reduction. It's about, what's the output level and what's the demand level in terms of forecasts. And if there's still a material imbalance, then, that's going to wipe out the effects of OPEC's cut in production, over the last few weeks. So that's going to be a telling sign for crude oil. So OPEC's monthly report, demand supply imbalances remain, and obviously there's the threat of a second wave that could really impact on demand.
Let's move on to some other currencies, Bob. Have you heard anything out of the UK?
Pound's been having a rough time of it again. Brexit uncertainty. Obviously, there's been no progress in terms of negotiations. That raises the chances of either an extension to the transition period or a hard Brexit. The UK government's unlikely to be particularly keen on adopting EU rules and laws should the transition period be extended. That's what the EU wants. So, if there's no blueprint by June or, possibly July, then, that hard Brexit is looking more and more likely. Then you've got COVID-19 numbers and obviously containment measures that are still in place. There's been some slight easing, but nothing significant. So that leaves the UK lagging its neighbours in terms of the easing of lockdown measures. So the economic recovery is going to be delayed. So that's another negative for the pound. No progress on trade talks with the US. That's going to be long in the tooth. So expect COVID-19 and obviously Brexit to be the key drivers. Economic data out of the UK on Wednesday. We got GDP numbers that are going to be quite dire. So that's going to put the pound under more stress.
Finally, to finish up, Bob, have you heard anything else notable in regards to non-macroeconomic data?
Away from the economic calendar, the real risk that the market's currently looking at is obviously a second wave of the COVID-19 pandemic. If we see any pickup in, obviously new cases across economies that have had lockdown measures eased, there is the risk of governments reversing those, easing policies, which would have a material impact on the economic outlook and obviously monetary policy, and those particular economies would be facing quite a raft. When you're considering what's gone on in China, South Korea, and even talks from Germany of new clusters, the outlook looks a bit glim for those that are, looking to ease. Interestingly, let's see what the US government does. Trump has clearly stated that by hook or by crook, the US economy will reopen, irrespective of the number of cases as a result of the easing of measures. So, that's another factor to look into. So, there could be more doom and gloom ahead for the economy should this happen. Then on the periphery, we've got obviously, chatter from Beijing and Washington on trade and sanctions, particularly if there's a second wave. I imagine Trump's going to have a fit. So that's one thing to look at. And obviously Iran still, those tensions in the Middle East are still lingering. So need to look out for that as well.
Bob, thank you so much for speaking with us. It was an absolute pleasure, and we look forward to speaking to you again very soon. Thank you everyone for watching. Don't forget to check out all of our social media platforms: Facebook, Instagram, LinkedIn, and Twitter. And we'll see you all again very soon.